Bitcoin is a risk-on asset, but it is a risk-off asset as well. And if there are going to be bankruptcy problems out there, then having a vehicle with no counterparty risk in a portfolio will become more and more important over time. Innovation solves problems. Last year, 2023, clearly the markets started to understand that the Fed was just about done raising interest rates. The Fed overdid it. In order to salvage margins, what will they do? They will start cutting back on employment, and the unemployment rate will continue to go up. It's still at very low levels, but it has turned the corner. We've been in a rolling recession for roughly 2 years now.
Get ready for a wild ride through the world of crypto, where even Bitcoin can't decide if it's a risk-on or risk-off asset. But fear not, because today we've got the roadmap to navigate the chaos. As Cathie Wood, the queen of innovation, takes the wheel, we'll be unraveling mysteries. Now, let's not forget to hit those buttons, smash the like button, hit subscribe, and stay tuned for more crypto thrills as we embark on a heart-pounding journey with the genius herself, Cathie Wood.
Last year, 2023, clearly the markets started to understand that the Fed was just about done raising interest rates. Now, the Fed kept saying higher for longer, and some Fed members were saying we've got to raise interest rates higher. Certainly Larry Summers, who's not a member of the Fed but seems to influence them, was saying that. But the markets started to see through that. And I do believe that 21 and 22, which were terrible years for long-duration assets, our kind of strategy, long-term bonds, the worst bear market, really in history since the 1700s. We've paid our dues. And now I do believe that what we were projecting or forecasting, and have been for quite some time, is that inflation, when history is told, inflation was transitory and a function of a supply shock and supply chain bottlenecks, and that it flipped pretty quickly from inflation down to 2%, past 2%, and into negative territory. That's what we think is going to happen this year. So I think the Fed will take note. And then the other thing that we believe will, with history as our guide, become obvious is that we've been in a rolling recession for roughly 2 years now. Number of housing measures are down 40%. New and existing home sales are as low today as they were at roughly the depths of the 08-09 crisis. We've seen auto sales not get back to the normal 17.5, 18 million unit range. We're in that 15.5, 16. So that's recession-like. Commercial real estate is in a world of hurt. And I think what's going to happen now, companies are losing pricing power. They're going to have to cut prices. They see that when they don't cut prices, their units fall apart. And I'll show you some slides on that in a minute. And so they're going to get religion. And in order to salvage margins, what will they do? They will start cutting back on employment. And the unemployment rate will continue to go up. It's still at very low levels, but it has turned the corner. I'm not thrilled about that. I just think the Fed overdid it. I don't think this was necessary, but we do think it's going to happen. The recession will not be as serious as 08 or 9. Nothing like it at all, partly because we've been through a rolling recession, and this will be the tail end of it. And so that, too, will move the Fed. And so we think interest rates are going to surprise on the low side of expectations as inflation and real growth surprise on the low side of expectations in an election year. So that's pretty interesting.
Cathie Wood is treating us to an even more immersive dive into the tumultuous waters of 2023. Last year, the markets were playing a high-stakes game with the Fed's interest rate dance. Larry Summers tried to join the bandwagon, but the market saw through it all. It was like a blockbuster movie, with 21 and 22 labeled as terrible years for long-duration assets, creating the worst bear market since the 1700s, a true cinematic experience. Now, here's the twist. Innovation is our superhero. Cathie predicts that the inflation saga will flip faster than a Hollywood plot twist, and the Fed will take notes. We've been riding a rolling recession for 2 years, with housing measures down 40%, auto sales playing hide and seek, and commercial real estate seeing the blues. And just when you thought it couldn't get more thrilling, Cathie unveils slides showcasing the intricate dance between economic factors. It's a spectacle of charts, predictions, and the financial world's version of a blockbuster script. We're not just watching the market, we're starring our very own financial epic.
You can see for the first time in history, our debt, our total public debt, this is federal debt, has crossed over. It did so, it was threatening to do so in the last 5 to 10 years. It did so decisively during COVID. Now, one thing about this is these are two different kinds of measures. Debt outstanding is a what they call a stock. It's an absolute number, level of debt. GDP is more of a flow. It is a measure of the goods and services produced in any year. And if we're dealing with a quarter, it's annualized. So again, any year. So different kinds of statistics. I think the debate is serious, but I don't think it is as serious as many think it is if we are right that innovation solves problems, and we're going to go into a period, thanks to unbelievable amounts of innovation. You just heard about Bitcoin. We believe that real GDP growth is going to be turbocharged. So the 3% that we've seen on average over the last 100 years in real GDP growth, we think is going to be much higher going forward as these innovations hit critical mass. And all of them are moving into prime time. So, and then you can see on this next page what I mean. So this is public debt outstanding. So that purple line on the previous chart, divided by GDP. And I do remember starting my career in the early days of the 80s. And oh my goodness, the debate was supercharged then as well. And what happened was Reaganomics or supply side policies did turbocharge growth in the 80s and 90s. And with a lag, we began to see the leveling out of this metric. We think there's going to be so much growth, so much more than even in the early 80s, that this line, debt outstanding to GDP, is going to come down fairly dramatically now that there is gridlock in Washington. And we believe that gridlock will be sustained during the next 5 to 10 years. Okay, so then on to monetary policy. Here, the purple line is money growth. And you can see the money growth rate is negative, and it turned negative. This we've pushed money growth forward, but it turned negative at the end of 22 and was negative throughout 23. We've pushed it ahead by 18 months and then put where we are with CPI inflation on top of it. Money leads inflation. And you can see what this chart is saying. It is very likely that we are going to move into negative territory when it comes to inflation in 24 and 25.
Crypto Street investors, grab those notepads and fasten your seatbelts because we're diving even deeper into an economic masterclass with Cathie Wood. The debt debate is serious, but fear not, innovation is here to save the day. In the early days, the debate was supercharged, but now, with gridlock in Washington, we're in for a turbocharged growth era. Watch out for the charts. Debt outstanding to GDP is about to drop dramatically, like a superhero landing, thanks to unstoppable growth. And when it comes to monetary policy, it's a negative growth party that might just lead us into the realm of negative inflation in 24 and 25. The crypto street roller coaster is far from over. Subscribe, hit like, and join us as we navigate the twists and turns of the crypto universe together. The adventure continues, and we're your guides on this thrilling journey through the heart of Crypto Street.